Good afternoon, everybody, and welcome to Essentials. My name is Dale Franklin. I'm an Executive Director of Anchor Financial Services, and it's an absolute pleasure to welcome you to another Essentials episode. It's funny how when time goes by, how certain buzzwords become everything that a financial planner talks about. So at the moment, inflation, what's happening overseas, all-time highs, and every client has an expectation that his financial planner has a crystal ball and has a great understanding of inflation. In this regard, we are going to be unpacking inflation today. We're going to have Peter Little and Casey Delport. Peter Little will take us through the dynamics of inflation, explain to you how it's calculated, and also give us a macro view. Casey will then give us a local view and pull it all together. I also have a co-host today, being Neil Brown, who heads asset management. So welcome, everybody. If you do have any questions, I could ask you please to put them in the Q&A function and not the chat function, and we'll handle as many as we can towards the end. Just a reminder, please to stay on for the full hour, or otherwise you won't get the one CPD point. Without further ado, I'd like to hand over to Peter Little.
Thanks, Dale. And thanks, everyone, for joining. So, as Dale suggested, I'm going to kind of take us through a very high-level overview of how we tend to think of inflation, what it means for our economies and our personal lives. And inflation, I mean, we've talked about it a lot. Again, Dale alluded to that towards the end of the last year when we started seeing inflation spiking around the world. We were talking about, how transitory it was going to be. Then when we had the Russian invasion of Ukraine earlier this year, we saw fuel and food prices start to spike and exacerbate that thing. So here we are back talking about inflation. And the reason we're so concerned about inflation is it's basically a health check for the economy. Much like our own bodies, we take the temperature to check the health of our bodies. Inflation is kind of the health check for the economy. And so if you think about these last couple of years, I think we've all had plenty of thermometers pointed at us to take our temperatures. The hope was that the reading on that thing would come out around 36 degrees, which I think is what we're supposed to be as humans. Like me, probably most of you had readings around 33 or 34 or something like that, which would indicate we were very close to death. Again, inflation in economies, if it comes in too low, is not a healthy sign, shows that economies are kind of dying out. And much like the reason we were having our temperatures tested during COVID, if our temperatures are too hot, much like inflation being too high, it's also an unhealthy sign. It could either be self-inflicted in the fact that we're overexerting and pushing up our own body temperatures to an unhealthy level, or it could be an indication of some underlying health problems or infections in our bodies. And again, inflation, if it's running too hot, will also give us an indication that either there's some inflicted overexertion from consumers that we need to kind of pull back before we push the debt levels and economic activity to an unhealthy or unsustainable level, or it's an indication that there's some underlying health issues with the economy and that we're not producing sufficiently or productively enough to meet the needs of the consumers. So that's why we're obsessing about inflation. It's basically the health check for the economy. So kicking into kind of broadly what it means and how we calculate inflation. On the right-hand side of the slide, I've got a quote there from an old US baseball player. I think he played in like the 60s and 70s. And he said inflation is when you pay $15 for a $10 haircut that you used to pay $5 for when you had hair. And if we take a step back from our professional roles where we're concerned about inflation as it relates to our investment portfolios or our clients' retirement needs, as a consumer, inflation is probably something that we tend to resent slightly. It makes us feel like we're overpaying for things. It makes us feel like we're paying more for something that we don't get any additional utility out of, or worst case scenario, like Sam Ewing, we think we're getting even less utility out of something that we're paying more for. And the reason that prices keep increasing is that that at their core level, on the left-hand side, most of you will have seen this slide in a textbook at school or varsity at some point. And prices are basically a function of supply and demand. And so to the extent that there's a certain amount of demand for a certain product, if the supply is not keeping up with that demand, then the price will have to go up to kill off some of the demand to make sure that it meets up with supply. And similarly, you can see if supply starts to increase beyond where the demand level is, the price will have to come down to stimulate that extra demand to meet up with the extra supply. And so we constantly see supply and demand moving around and prices trying to find the point where we find that equilibrium. And supply and demand move for different reasons. So demand can be moving for reasons that we see, like people are getting wealthier, so they have new demand, or their needs have changed, so demand change. Supply can similarly change in response to opportunities in certain sectors, or in response to things happening in the underlying supply chain. So at its most basic level, if you have a bad weather event, farmers are unable to supply enough grains as a result of poor crop yields, that brings down the supply. Demand hasn't changed, the price needs to go up. So we're constantly monitoring kind of supply and demand dynamics, which are moving in opposite directions, often for very different reasons. And we need to understand why they're happening in order to understand what's driving the price changes. And that will give us a sense of how healthy or unhealthy the economy is. Now, we throw around inflation like it's this kind of homogenous concept, but in reality, inflation is calculated very differently by different countries for different reasons. And inflation is generally calculated based on a basket of goods that represents what the average consumer in a certain country is going to consume. Of course, there's no average consumer. Some people are consuming, very different things to other consumers. And so everybody will feel that the inflation number might not be quite right for them. But the idea is that economists and central bankers are trying to come up with a basket of goods that best represents the broad economic activity, spending activity by its populace. And that will give them the best idea of kind of broadly speaking how the economy is doing. And so what I've shown on this chart is across different countries, just two of the components that are particularly in the news at the moment: energy and food prices, largely as a result of what's happening in Russia and Ukraine. And just to try and show you how different those can be across different countries. And there's good reason for that. In emerging markets like India or South Africa, the proportion that consumers spend on food and fuel to heat their homes or to run their cars is much higher than the proportion that people spend on those items in wealthy countries, where they have much bigger incomes and much more of their spending is going on high value add items, services, and the likes. And so every consumer or the aggregate consumer in different countries is going to look different for very good reasons. And each country will try and create its own basket to look at that. What's important was at a country level that those numbers are consistent, so that from month to month you can compare how the trajectory of inflation is moving. But you can't always compare these things across different countries. And even within any particular country, the US, for example, has a number of different inflation measures. It has what they call CPI, so Consumer Price Index, which is the one that tends to find its way into the headlines. And that's weighted slightly differently than the PCE inflation, which is the personal consumption expenditure inflation, which their central bank tends to focus on. And the big difference between those things is the basket of goods is weighted differently. And even in most of these baskets, there's goods that we have to sort of infer or impute the price. So something called owner's equivalent rent. In most countries, people a large part of what they spend on is housing. But frankly, a lot of people also own their own homes. So they're not necessarily shelling out money every month for their home. They might have fully paid it off, or they might still be paying it off by a mortgage. So it's very difficult to try and figure out what portion of people's consumption is going to housing. So economists come up with this concept called owner's equivalent rent, which basically is a survey measure that takes people who own their own homes and phones them, and they say every month, what do you think you'd be spending on rent if you didn't own your home? And then they do the same thing every month to figure out sort of the owner's equivalent version of rent, and that's, I think in South Africa, it's about 11% of our inflation basket. In the US, if you look at CPI, it's kind of somewhere in the region of I think around 24%. But if you look at PCE, it's much lower than that, around 10%. So all of these components are kind of sometimes difficult to understand and calculate and very different across countries. But the important thing is that we still need to test the health of the economies. And even though we can't necessarily compare these things like for like across country, they are still an important measure to look at to measure the health. So what I've shown on this slide here is, as we explained, that consumers in developing and emerging markets tend to have very different consumer patterns. Now, the charts on here are broken down into 3 different components: energy, food, and core. So energy and food tend to be pretty volatile things. The food prices tend to be volatile depending on seasonality, weather issues and seasonality issues. Similarly, energy prices tend to be pretty volatile based on geopolitical reasons or other sort of supply issues. And a lot of the oil obviously comes from areas where we see significant geopolitical risks. So these 2 components tend to be very volatile, and often economists will exclude those to try and understand the sort of broader underlying trend of what they call core inflation, which is the stuff that has much more stable prices, the goods and services that we tend to buy on sort of an ongoing basis, where we don't see wild swings in the prices from month to month. And I thought what was pretty interesting from this chart is on the left-hand side, this is for the developed markets, and on the right-hand side, this is for the emerging markets. And obviously, the green and brown bars here are the energy and food components. You can see those kind of jump around from being inflationary to deflationary and vice versa. But what you'll see on the left-hand side here is in developed markets, the core inflation, so the rest of the components that should be relatively stable in their prices, have started to creep up pretty dramatically over the course of the last year or so. And this is why we're probably talking more about inflation than we have for ages. This sort of headline inflation is painful, and it's particularly painful for lower income consumers when food and energy prices bounce all over the place, and particularly when they get higher. But core inflation tends to become the self-fulfilling prophecy. And although we said that supply and demand tend to set prices based on those 2 variables, inflation also has a very psychological component to it. And so, in South Africa, we will have seen, for example, that people have the 6% number in their head for inflation because it's been that way for absolutely ages. And so you sort of start to preempt that, and it becomes self-fulfilling. So if you think about employees, they want to start their wage negotiations at 6% per annum increase. Landlords want to have a 6% escalation clause in their rental agreements because they think inflation is happening at that level. And if you're a business owner and your staff costs and your property costs, your rental costs are going up automatically at least 6% a year, well, then you have to put the price of your goods and services up 6% a year to compensate for that, so you don't get margins squeezed. And so because people believe inflation is at a certain level, that tends to become self-fulfilling. And so a lot of what you will have seen over the course of the last couple of, or the last year or so is that central banks are very focused on inflation expectations because they want to make sure that people aren't sort of anchoring this new level of high inflation in their minds, and it starts to become self-fulfilling. So inflation, we've talked a lot about it. We understand where it's coming from, but is it bad? So it's only bad, like our temperatures in our body, if it's not at the right level. And each economy will have a temperature or an inflation level that's appropriate, that's the most healthy for it to run at. In developed markets, we tend to think that's around 2%. In emerging markets, it's slightly higher. South Africa, we're sort of shooting for 4.5 at the moment. And we want to get that level of inflation just right. And so on this slide, I've got some pictures there of the sort of Goldilocks porridge, too hot, too cold, and just right. And so much like Goldilocks had a temperature that she needed for her porridge, each economy, as I say, has a temperature or a level that it needs to run at for inflation. And anything outside of that temperature is in fact bad. So inflation itself is not bad, but inflation at the wrong level for a certain economy is bad. If inflation is too hot for that particular country, it starts to erode the savings. So the value of our savings, the time value starts to erode. It erodes our purchasing power. The money that we have now is going to buy us less as prices get higher. It tends to delay investment decisions. So when businesses and companies are thinking about creating productive capacity to produce goods and service, if they're not certain about where those goods and services are going to price going forward, if the prices are going to hop around or escalate particularly quickly and their costs are potentially going to escalate pretty quickly, it's much harder for them to figure out if new projects or new capital spend will be efficient. And so they tend to delay capital spend when you have inflation that's very high. It also increases the cost of borrowing. We'll touch on central banks later, but typically when inflation starts to get too hot, the cost of money starts to get pretty hot as well. If it gets too cold, so if inflation is too low, you would generally think maybe that's great that prices aren't going out. As a consumer, that certainly is, but it tends to also create its own issues. So if we think that the prices are going to go down for things, or at the very worst, they're going to stick around these level, it means that we're not in as much of a hurry to go out and buy things, and we delay these spending decisions. And of course, consumers are at the heart of economic growth. Our spending is what drives most of our economic growth. And so if we start to delay spending decisions, that slows down economic growth, and economies, much like bicycles, once you slow them down past a certain speed, they start to fall over. So you need this level of momentum. And that's why at just the right level on the right-hand side there, prices are rising fast enough that it's encouraging us to go out and spend, because we know prices are going to get slightly higher in the future, but they're not going to be all over the place. So we worry about, are we saving enough in case things get really expensive, or are businesses willing to start doing new things? It's economic activity at just the right level, with the consumer kind of leading it by going out and spending because they don't want to delay that decision. That's when inflation is good. So we've seen a term bandied about over the last probably 6 months or so. Stagflation's probably popped up in a few research articles or newspapers or the like that you've read. And stagflation is basically, as the picture on the left-hand side there depicts, inflation is high and economic growth is either low or non-existent. And that's a pretty toxic combination. We haven't had a hell of a lot of experience with this. I think this term stagflation was developed in the 60s by some British politician. We had stagflation in the US in the early 70s, but not much is known about the causes of inflation, because it hasn't actually happened a whole lot in economies over time. And so we can't sort of see the patterns that predict it. When we had stagflation in the US in the early 70s, it was at a time when Nixon had taken the US out of the gold standard. So they sort of depegged their currency, and that was creating all sorts of uncertainty. And then the OPEC countries stopped supplying the US with oil because of the US's support for Israel. So there were geopolitical issues, and price of oil went nuts in the US. And so you had all these sort of external shocks at the same time as the US economy was kind of struggling to gain momentum when these things happened. And so you had this brief stagflationary period in the US. But it's difficult to determine exactly what pushes an economy into stagflation. And so it's hard for us to imagine an environment where we're going into stagflation going forward. But certainly stagflation is not a great outcome for any economy. If I look at that sort of compass on the right-hand side there, we want to generally be in the top left quadrant of that. We've got low and stable inflation and strong economic growth. If economic growth gets too hot and creates high inflation, you get overheating. We don't want that. Again, if inflation gets too low and you lose economic momentum and get low GDP growth as well, you're going to deflation. That's also not great. So we generally want to be in that top right-hand corner. The bottom right-hand corner is probably the worst situation you can be in, because it's very difficult for central banks to respond to that. They don't want to, the central bank's tool for keeping inflation under control is generally to try and reduce demand by increasing the cost of money. And that slows economic activity down. And it works really well if we're in that top right corner when consumers are kind of running ahead of themselves. But it doesn't work particularly well when you're in stagflation. In fact, it might actually make things worse, because you're already in a low growth environment. So you don't want to push growth any lower, because then it loses momentum and falls over. And frankly, it's not sort of elevated economic growth that's causing the inflationary problem. But so we don't think that we're heading into that kind of environment going forward. But certainly that would not be a good outcome. Is stagflation bad? I mean, I think that's one's pretty obvious. It is bad. I've got a chart here. They call it the misery index. That's sort of attempting to measure stagflation. This particular one is for the US, and it simply just adds unemployment and inflation numbers together. And you can imagine in a stagflationary environment, when you have low economic growth, you have high unemployment. And if you add high inflation to that, obviously the misery gets pretty intense. And as I say, we had this period in the early 70s in the US when that happened. We haven't really seen another cycle like that. If you look at this other peak that we had around the 80s here, you started off with high inflation. Obviously, central bank responds to that. Inflation starts to come off, but a sort of consequence of that is you start to see unemployment increase, because the way that they've killed inflation is by slowing economic activity down, which obviously leads to unemployment. But if these things sort of lag each other, that's fairly normal in the normal cycle of things. What you don't want is them to happen at the same time. So again, I'll just look at US inflation. Casey will take us closer to home for South Africa for the second part of this presentation. But US inflation is kind of a good sort of proxy for what's happening in developed markets. It also tends to be a big driver of what happens to the cost of money in developed markets. And what I've got on this chart is just a breakdown of what's been driving US inflation for the last decade or so. And there's a few things that you want to take away from this. So from, pre-COVID economy, US inflation was running pretty close to 2%, which is obviously their target. So all good on that front. And the majority of that is made up of these light gray bars, which is services inflation. And service has a big component of housing in it, has a big component of medical in it, but also all sorts of other things. But it's about 2/3 of what Americans spend their money on. And that stuff was, inflating at higher than 2%. So inflation in services was about 3%. But because there was no inflation in the other goods part, that's the second part that you want to take away from this chart, that sort of equaled things out. So I've got three goods components in here: new cars, used cars, and everything else. And these are physical things that we purchase rather than services. And you can see that over the course of this sort of decade or so leading up to the pandemic, you basically had no inflation in goods. Or particularly immaterial inflation, at some point even slight deflation in those things. And that's what's really kicked off during the pandemic. So what we've seen for the first time in frankly decades, because this picture wasn't particularly different in the decade or so before this, We've seen for the first time in decades goods price inflation coming in over here. And the right-hand side in this red bar, which is used car prices, this dark blue bar, which is new car prices, and the gray goods, the gray bars, everything else. And that's been a key driver of the latest bout of US inflation or developed market inflation that we've seen happening. And it's happening when we think of supply and demand. So you've had demand boosted by a couple of things. So the first thing is that obviously during the lockdown, people are unable to spend on services, which makes up a big chunk of their spending basket. Obviously things like housing they were still able to spend on, but a good chunk of that services basket that they weren't able to spend on now meant they had excess money to spend on the only thing that they could spend on, which was goods. So they were increasing demand from that perspective, just the substituting of spending. And then to exacerbate that demand, you also had the government come in and stimulate with fiscal stimulus. So people got checks and the like. So they had more money to spend and they had less things to spend it on. So this created extreme amount of excess demand in goods. And this was all happening at the same time when goods were much more difficult to supply because of the pandemic. Obviously, some factories were closed, transport was restricted, and so it was harder to supply goods at the same time as there was this incremental demand for goods. And so we've seen that part of inflation or that part of the inflation basket really cause a major problem over the last couple of years. We continue to believe that this part will be transitory, that people will go back to their sort of pre-pandemic spending habits by spending less on goods. Obviously, the fiscal stimulus will eventually run out, and our ability to supply those goods will eventually normalize. So this part we do think is very transitory. What's been probably slightly more concerning over the course of the last few months is the light gray bars for services. That's been kind of ticking higher to a run rate that was operating at above its pre-pandemic level. And remember, I said that this can kind of become slightly self-fulfilling if we see this happening. And so this is an area that we'll keep pretty focused on because that's somewhat concerning. And then the rest of this chart is sort of food and energy. And as I said, this stuff tends to bounce around. We'll eventually figure out how to get enough food and energy to people, and that will become deflationary again. But for now, it's obviously exacerbating things. Inflation expectations is pretty interesting because, again, as I said, the sort of psychological component of inflation is pretty important. And so what I've got here is two probably overly complicated charts. So we'll just touch on them very briefly. On the left-hand side in the brown bars here, this is actual inflation in the US. And obviously it's started to spike over the last 6 months or so. And then I've got three measures of inflation expectations. I've got in this dark line here what economists think inflation is going to do over the next year. I've got what markets think. There's some inflation swaps that price in where investors are willing to bet inflation will end up over the next year. And then this light blue line is where consumers regularly surveyed consumers will believe that inflation is going to over the course of the next year or so. Economists tend to kind of be slow to respond to inflation. They think that central banks will ultimately get this under control, so they tend to be less pessimistic about the course of it. Consumers are the most pessimistic. So when inflation is high, they think it's going to stay there forever. When inflation is low, they think it's going to stay there forever. So they're not a particularly good leading indicator for this. But the point is that everyone thinks that inflation is going to be going higher over the course of the next year, but not as high as it currently is. So most sort of sectors of the economy believe that inflation is coming down somewhat. And then on the right-hand side here, I've got just those expectations for those same groupings for inflation 3 years out. And the big thing that you want to take away from here is the fact that for all of these components, they think inflation over the next year is going to be higher than inflation is going to be in 3 years' time. So everybody still generally believes, even though they think that inflation will get slightly higher, that it will be operating below the levels that we're seeing now, which is encouraging because we don't want those inflation expectations to get unanchored and become self-fulfilling. Now, we want to take the health of the economy because that's pretty important. And so we're looking at inflation for that reason. But the link between the sort of health of the economy and inflation and our own investment portfolios is generally via the central banks. And so we think of them as kind of the doctors of the economy. So their job is to make sure that the economy stays at the right temperature through time. And the way that they generally do that is by changing interest rates. And the higher the interest rates are, the higher the cost of money, the more that sort of kills off demand. And if you lower demand, you hopefully bring down inflation. So that's the central bank's job. They're the doctors trying to bring inflation back to where it's supposed to be. And what I've got on this chart here is just in this brown line at the bottom here, this is what the US central bank is actually doing. So we've seen in the course of this year that we've had now 3 hikes from the US central bank of essentially zero interest rates, and rates are now around 1.5%. But the line that I really want to talk about is the squiggly blue line over here, which is, again, this is investor expectations for where the Fed is going to. And if we look back around sort of the last quarter of last year, investors were thinking, and this is where investors think Fed rates are going to end up at the end of 2022. So in the last quarter of last year, investors thought the Fed would hike to sort of 50, somewhere between 50 and 1%, 50 basis points and 1%. And then gradually, as time went on, inflation started looking a little stickier than it was. I thought, well, the Fed's going to probably have to respond more to this, but not particularly harshly, maybe like an extra 25 or 50 basis points of cut. And then when we had the conflict in the Ukraine, that's when things really kicked off, and people believed that this sort of additional inflationary shock was going to have to make the Fed move pretty quickly. And so expectations have moved pretty quickly for where the Fed is going to have to get to and how quickly they're going to have to respond to crush this economic overheating that we're seeing as a result of all of these different supply and demand issues that are going on. And the reason that I touch on expectations is that it's pretty important in the link between inflation and our own savings. Because ultimately investment markets are forward-looking. And so if we're trying to think, if we're looking at inflation as a gauge of like how it's going to impact our wealth and our savings and our ability to retire comfortably, the sort of link between that and central banks and investments is tends to be a forward-looking one. So, as you can see from this chart, we thought, this cartoon on the right, we thought markets were our friend, helping us kind of grow our savings. But every now and then they kind of strike back and scratch us. And that's certainly happened year to date. And it's not because central banks have already significantly tightened liquidity conditions. It's just that investors have taken a look what's happening in inflation and decided that central banks are going to have to do something fairly draconian to get that under control. That's going to have economic consequences. And so investments have almost preempted that and have now kind of sold off. We've seen some pretty heavy losses globally in dollars across stocks, bonds, property. In South Africa, we are actually significantly better off than your average global investor, particularly when measured in dollars year to date. Although no saver or investor is going to be excited about seeing negative numbers there. So we've already moved to bake in a lot of expectations based on the fact that we've looked at this temperature gauge for the economy and decided that there is some unhealthiness happening there, and we're kind of preempting where that's going. And I'm going to actually leave it there and hand over to Casey, who can bring this all closer to home and tell us about how this is going to pass on to our local savings. Thanks, Casey. Over to you.
Great. Thank you, Pete. And good afternoon, everybody. Let me just get my screen up. Okay, great. So yes, up until this point, Pete has gone through the various dynamics of inflation, theoretical dynamics, why inflation is so important to us at the end of the day, the impact that it has on our investments, and what's sort of going on the global sort of macro environment. It's now my job to bring it down to the local level to understand exactly what is going on here at home, given that South Africa, of course, as usual, has many of its sort of own different homegrown issues currently at play. So on that note, I think it's important to take a step back first and understand, to look through the global volatility, which Pete has sort of gone through now until this point, and really understand what is the actual current economic situation in South Africa. We have some very many other idiosyncratic issues at the moment that we do not see in the more developed nations. So to start off, South Africa's economic recovery from the depths of the pandemic-induced lockdowns has generally been faster than anticipated, and some of that momentum has clearly carried over into the first quarter of this year, with the latest GDP print coming in ahead of most forecasts at 1.9% quarter on quarter. But if we look ahead into the second quarter and even further on in the year, the general economic outlook is starting to look a bit more clouded due to the slowdown in economic activity in South Africa's key trading partner countries due to the ongoing war in Ukraine, as well as the lockdown restrictions, although now beginning to ease, brought about in China by that country's zero COVID policy. In addition, we expect the high interest rate trajectory to be a drag on household consumption and thereby domestic GDP growth. But I'll speak to that a little more in a moment. And in addition, we've had those recent floods in KwaZulu-Natal, which also pose a significant risk to growth. Just bear in mind that this flooding occurred during the second quarter in April and May, and in turn will only reflect in the second quarter GDP results released during September. And the damage to key infrastructure, such as the collapse of bridges, damage to roads, ports, etc., has really hindered economic activity and disrupted the transportation of goods. Further compounding the matter has been the various security issues and bottlenecks on Transnet's railway and ports, which is likely to negate the impact of the positive terms of trade shock on real GDP growth. And in addition to this, we have a very different, labor market scenario in South Africa compared to that of the US and the UK. We just don't have such a tight labor market. We actually have the complete opposite. And bear in mind that our current unemployment rate sits at 34.5%. If we consider our expanded unemployment rate, which includes all our discouraged work seekers, that's now sitting at 45.5%. We have a youth unemployment rate of 63.9%, to make matters even worse. So again, we're sitting with a very, very different issue here in South Africa. So as a result of these sort of many factors, South Africa's inflation story also remains very different to that, again, of the likes of the US, the UK, and even that of the Eurozone. If we consider the latest print, it came in at 6.5% year on year in May versus 5.9% year on year in April. And, it's this latest sort of headline CPI print, which has now officially breached the upper limits of the SARB's target band. A reminder that our band sits at 3 to 6%. If you look at the graph in front of you, you can see it's denoted by that gold band. And in addition, this latest print was also above expectations, with the upside surprise stemming largely from food and fuel prices once again, but with core inflation matching the consensus forecast of 4.1% year on year. And this is sort of really key that I want to underline today, particularly from a sort of monetary policy perspective. It is important to note that this sort of latest inflationary overshoot was, driven once again by food and fuel prices, with the upward drift in core and services inflation still gradual as expected. Again, a very different scenario compared to the sort of developed markets that Peter's just sort of outlined. If we consider our transport and food and non-alcoholic beverages, so that accounted for just over half of the annual rate, with the sharp increases recorded in both categories. Fuel in particular continues to be a major contributor. If the impact of fuel is actually removed from the May CPI reading, the headline rate falls to 5.1% from 6.5%. To place it in further perspective, diesel prices jumped 8.1% between April and May, taking the annual rate to a 45% plus increase. So the average price of a litre of diesel in May 2021 was 16 Rand 20, meaning it cost 729 Rand to fill a sort of average 45 litre tank. 12 months later was the average price of 23 Rand 67 a litre. Filling that same tank cost around 1,065 Rand. So that really does sort of put the scenario into a bit of perspective. What is quite interesting, though, is that petrol prices did actually moderate between April and May, edging lower by 0.7%. So, despite this decline, petrol is still 27% more expensive than it was in May 2021. And to move on to sort of another key part of the inflation story in South Africa is, again, food inflation. And that is set to remain quite sticky for the foreseeable future. Your higher agricultural commodity price pressures saw the food price inflation rate rise to 7.8% year on year in May, contributing to 0.4% to that overall 0.7% month on month lift in CPI. So quite a significant proportion. And whilst typically South Africa produces enough food locally to hold a comfortable level of food security, the country as a whole, we remain an agricultural price taker at the end of the day, just simply as a function that geographically we cannot produce all of the food items that we require, due to our landscape, our climates, etc. We are forced to import some of the food items that we need. So as a result, the international food prices really are a key driver of our domestic prices at the end of the day. And if we consider these sort of global food price dynamics that have been at play for several months now, yet in some cases they have also deteriorated. And the reasons for this include China's zero COVID policy, which continues to disrupt manufacturing and global logistics. Of course, Russia's invasion of Ukraine, which, as we all well know, has heightened concern around global supply at a time when stock levels had been declining for several consecutive years already. We also see persistent concerns around weather conditions, which curtail the supply response and policy actions in response to surging prices in some major producing countries as well. And this includes a ban on palm oil exports from Indonesia, which is actually the largest global exporter. And this, which, was really turning to drive already high vegetable oil prices up further. We also have India's ban on wheat exports, further compounding this. We have weather conditions in the US, which have also delayed plantings of summer grains and oilseeds, which have really, further supported price gains in turn. And these persistent increases in agricultural commodity prices globally have filtered into the South African market, supporting high prices amongst major grains and oilseeds, despite the expectation of another bumper crop, which, should ease any concerns around availability and ensure that commodity prices continue to trade at export parity levels. Global factors have also contributed to rising meat prices, notably the continuation of intermittent avian influenza outbreaks, I think typical bird flus, as well as supply constraints emanating from prolonged periods of high feed prices. However, we also have several domestic factors that have also contributed to these higher food inflation prices, such as reduced slaughter volumes as well. In fact, since the Russia-Ukraine war began and really disrupted particularly the global grains market, the global agricultural commodity prices have increased significantly, with the FAO's Global Food Price Index in May averaging 157 points, which is up 22% year on year from a record high seen back in March. So what does this really mean for us at the end of the day if we consider sort of the interest rates environment in South Africa? And what we're really seeing is a continuation of the rate hiking season, really. And I think it's also important at time to take a step back and remember exactly where we are in the interest rate cycle. A lot of consumers are also feeling the brunt of these higher rates. But I think it's important to bear in mind that if we consider where we were back before COVID struck, so say around Jan 2020, the SARB had actually just decreased rates to 6.25%. So where we are currently at a repo rate of 4.75%, we still actually have quite a bit of distance to make up before we reach that sort of pre-COVID norm. So if we look ahead, and we consider, I think, June's CPI data, which will be released in July, that'll be fairly important because it will include the quarterly survey of the weighty rental inflation category, which is usually regarded as a barometer of demand pool inflation. And, this will be very particularly important from the monetary policy perspective, because up until now, South Africa's inflation story has really been an issue of supply-driven constraints as opposed to demand pool. So it's important to see when this print follows through if this is very much still the case. Nonetheless, on an annual basis, we now project inflation to reach 6.7% in 2022. And, should the June print pull higher still, which at this point is very likely, we're seeing it reach sort of the high 6 mark or hover around the 7% mark. If we were to take that scenario, couple it with further rand weakness, for instance, then there really would be a strong case for greater front loading of the sort of interest rate hikes. In this case, a hike of 75 basis points in the July SARB monetary policy meeting could really well be plausible. However, based on this latest print alone and the various sort of respective drivers that I just spoke through a moment ago, we believe that the SARB will likely hike rates by 50 basis points in July. It was quite interesting. Just this morning, the governor of the Reserve Bank actually came out and said that a 50 basis point hike is entirely plausible at this point. And if one reads sort of the underlying nature of that kind of comment, essentially what he's saying is that a 75 basis point hike at this point is sort of off the table if they're just considering a 50 basis point hike. So that really reiterates our forecast of the 50 bip hike in July. But from there onwards, I think it could really go, 50-50, it could be split either way. We could see 2 more rate hikes in increments of 75 basis points in the September and November meetings. Or, on the other side of it, the SARB could decide that it's, further front loading of the cycle is necessary, and they could hike by another further 50 basis points in September and then pause in the November meeting. But either way, depending on the timing, we still see the repo rate being hiked by another 100 basis points or another full percent. And this would take the repo rate to around 5.75% by the year end. If we move into 2023, we'll see another 100 basis points worth of hikes, the timing of which at this point is impossible to sort of forecast. We're just looking towards the remainder at the end of the year. I think that the last point that I really want to make today is that, at the end of this, despite all the forecasts and running all the numbers, at the end of the day, there really is a limit as to how high rates can go in South Africa. The SARB has to be cognizant of the detrimental impact of a hiking cycle that is too severe on South Africa's already strained economy. The average South African consumer remains under increasing price pressures along with sustained high unemployment. If we take into account the other various, idiosyncratic issues I've just discussed, coupled with this current bout in intensive load shedding, which seems to be stuck with us for a few weeks yet, the short-term economic outlook is starting to look increasingly cloudy. But at the same time, you can see it's a really fine balancing act. We cannot discount the various inflationary upside risks at this point, which would lead to further front-loading of the interest rate cycle. So it really will be a fine balance to achieve. And at this point, much like many of the central banks across the globe, the SARB really has to walk a very fine line, perhaps more in South Africa than in the likes of the US or the UK or sort of our other developed nations. And that's really my sort of piece for today. Going to stop sharing and sort of hand back over to the moderators, to either Dale.
Thank you, Casey, and thank you, Peter. Interesting and insightful as ever. If I could ask everybody, please, to put your questions in the Q&A function, and let's get going. So, first question, Peter, I think this is for you. Surely one main issue is that the labor cost is what the Fed is trying to control. Cheap money means more money on the capex, so more jobs, and issue in the US is people not returning to work.
Yeah, thanks, Del. That's a good question. So the sort of relationship between Wage growth and inflation was something that is defined by a thing called the Phillips curve. I think it was a Kiwi economist back in the 60s or 70s created this economic model that tried to measure the relationship between wages going higher and inflation going higher. And it's basically a concept of cost push inflation. So if the cost of production went up, producers had to push the price of their goods up in order to maintain their margins. And that was a kind of theory that people looked at for a very long time. But that relationship started to break down in developed markets when you had a couple of things happening. You had firstly the fact that that labor markets were, I don't know, Dale, is that you? That's not on mute there. Got some background noise coming through. So you had a couple of issues over the last sort of 20 or 30 years that made that relationship not as stable as it used to be. And the first thing was that that people started moving towards sort of higher value add services where the labor cost as a proportion of the cost of the service was pretty low. So if you think if you're buying high margin services and the labor cost is only sort of 10 or 15% of the cost of that good, small sort of big changes in the labor cost doesn't really have a big impact on the production of that service. And so the kind of pass through from labor to high value services was not as strong as we'd seen when people were consuming more goods. So that was the one thing that happened. And then obviously this sort of globalization concept where, if the cost of labor was pushing too high in one jurisdiction, you just outsourced that cost of production to another low cost labor jurisdiction. So that those two things sort of rendered that relationship between rising wages and rising prices, not as closely related as they used to be. So certainly, we kind of think of wages as being a function, being driven by higher inflation more than higher inflation being driven by higher wages. And that's the relationship, certainly in developed markets, that we've seen over the last couple of decades. That's not to say that economists and central bankers don't care about the wage growth. What they're more concerned about is if that wage growth becomes entrenched. So if we see sort of a spike in wages to try and attract all of these people that Simon referred to sort of dragging this lack of supply of labor, if we see that the spike in wages that has to pull these people back into the labor market becomes sort of psychologically entrenched. So now people are expecting to get these big wage increases, then it becomes more problematic because then it becomes sort of self-fulfilling. But for now, we see these spikes in labor prices as more as a kind of a temporary adjustment to get the economy kind of back into sync after the pandemic. And it's not going to be irrelevant to inflation, but it's certainly not the key driver of inflation for now.
Great. Thank you, Pete. I think this next one is for you, Casey. It seems the term transitory is used so often. What is the definition in terms of duration when referring to transitory?
That's a good question and actually quite a tricky one. In traditional economic theory, there is actually no formal definition for what determines transitory inflation. It depends on a sort of more country basis. Even then, a country's central bank, I believe the Fed, for instance, has never put out a formal definition of transitory. That's why I believe it's bandied about so often at the moment, because there is a point in which you say, what level is transitory or not. At this point, I think it's important to look at what are the underlying drivers of inflation, and that really depends if it's transitory or not. Again, we've talked a lot today about energy costs and food-related costs, etc. Those are typically drivers of transitory inflation because, as Pete mentioned, they do tend to be extremely volatile and move up and down constantly. So that's normally always pulling up and down. When we start seeing core inflation hiking up, and the concerns coming around for economists that then it is indeed sort of a less of a transitory environment. Pete, I don't know if you maybe want to add on a little bit more to that or not.
Yeah, I think that's spot on, Casey. You've nailed it there. There's sort of some components that we expect the prices to mean revert, and that's food and energy. And so When we say transitory, those things we kind of know the production will catch up eventually and the supply issues will be resolved. And so because central banks respond with a delay, so they're kind of raising interest rates, and that will gradually increase or sort of slow down demand. They don't want to be responding to things that by the time the demand destruction kicks in, the supply has already sorted itself out. And then the other key thing for transitory here is just the fact that they just don't want these inflation expectations to become unanchored. So you don't want the cycle, you don't want inflation to stick around high enough for long enough that people expect it to stay there. And as I say, that's kind of becomes self-fulfilling. So you have transitory components, which will revert to mean, and then you have sort of transitory behavior. And I think, if inflation was to stick around for elevated levels for like more than a year, I think then you worry that expectations will become unhinged and it will become self-fulfilling. So I think that's more of the transitory issue that central bankers will be looking at.
Next question actually is for both Casey and Peter. So I think you should both be able to comment on this. Given the higher inflation and lower trending GDP in South Africa, are we already in a stagflation environment, or is the possibility increasing? If so, how will asset managers respond to this risk?
Okay, great. No, that's a wonderful question. Up until this point where we currently are, I don't believe South Africa is in a stagflationary environment. A lot of those factors that I mentioned in my presentation was more concerns for my outlook sort of, going ahead. I think it's important to remember that as it stands, South Africa has had a much stronger rebound from our COVID levels. Our economic growth has been stronger than anticipated. I'm just now more foreseeing for the remainder of the year a slowdown in our growth projections on that note. So there we don't see sort of stagflationary. And again, up until recently or even till now, our drivers of inflation have been your transitory elements of food and energy. We're not sort of seeing that core component increasing up higher. And then before I hand over to Pete, I think from an asset management perspective, well, then it's going to very largely depend on which asset classes you're sort of functioning in. I come from the fixed income desk where in a sense, interest rate hiking cycles is actually positive for our element of the business. It means a lot more hard work from our side in terms of where we position ourselves along your sort of, typical bond curves. Because inflationary issues always sort of hit you in more short-term dated bonds. But then, again, from an equity perspective, it's a whole sort of different scenario. Maybe Pete, you can add on to that.
Oh, Casey, thanks. I think you've covered that well. I'd say, I'm on your page that I don't think we're certainly not in a stagflationary environment. Remember, emerging markets expect to have a higher sort of run rate of inflation. And I don't think we're dramatically above that. I think we're still, certainly at a core level, pretty close to pretty much within that band that we're expecting inflation to be. So we don't think we have above average inflation, which is kind of one of the components of being in a stagflationary environment. We're certainly probably operating at a below average growth run rate for various reasons, including Eskom. And so that means that we're running at a higher unemployment rate that we should do. We're not able to sort of drag all of that growth into the labor market. So the unemployment part is probably higher than we'd want it to be. But I think you need both of those components to be higher for us really to be in a stagflationary environment. And then kind of tagging on from what Casey's saying, you obviously have sections of the fixed income market that are happy in that environment. Certainly equities and domestically focused equities that are reliant on South African economic growth on a much tougher space where your economic growth is not, so sort of aggregate demand is not growing particularly fast, but your cost pressures are growing at a pretty high clip. We're not, as I say, we're not there yet. But if that were to happen, it would be very tough for domestically focused companies to maintain or grow earnings strongly.
Pete, would you say that Zimbabwe is a typical example of stagflation?
Yeah, that's probably a good example where unemployment. Well, certainly if you measured their misery index and added their inflation, which is I don't know hundreds of percent, or very hard to measure at the very least, and extraordinary high unemployment. Yeah, Zimbabwe certainly ticks those boxes.
Next question. I noticed that the oil analysts are calling for higher oil prices into year end. Some are taking it up to $145 per barrel. How much pressure will this put on the US and SA to further hike rates?
Maybe I can start that off and look at the US. So certainly the oil at $145 a barrel is what like 30% higher from here. So that won't help. I mean, in theory, the Fed will look through that, because unless we believe that oil is permanently going to be at $145 a barrel, it's unlikely that they're going to try and kill demand or sort of increase rates to kill demand to bring the oil price down. And oil at 145 is much more of a supply problem than a demand problem. And the Fed can obviously only respond to demand issues. That being said, you start to have second order effects. So, the cost of transporting goods and the cost of manufacturing goods starts to get higher. And if I think the question suggested that it was still going to be there at year end, will mean that these kind of inflationary, and especially the second order inflationary impacts are kind of lingering for longer than we would have liked, and at risk of unhinging inflation expectations. So the Fed will, in theory, they can ignore it because oil will eventually revert, but it will certainly be not helping them to the extent that the other things are not self-correcting. So to the extent that we're not seeing goods price correcting and offsetting that to a larger extent, that will make their job somewhat harder.
I'm going to move on to the next question, just so we can cover everything in the time. Next question is for you, Casey. Does your SA inflation scenario also include local labor costs? E.g., if Eskom settles the wage demands of the unions, and this then creates a precedent for other governments and parastatal unions?
Okay, so our current forecasts are not anticipating any further massive hikes in sort of government wage-related issues or negotiations. I think it's important not to bundle the Eskom scenario into the rest of sort of our government SOEs or parastatal wage negotiations. It's a very, very its own sort of special case at the moment, which we could probably present an entire different webinar on. But, in terms of the rest of the wage inflationary pressures in South Africa, no, the government has been very sort of upfront and been pulling a surprisingly hard line on government wages at the moment. They are cognizant of the fact that we are in a fiscal situation that just cannot handle those level of pressures. We are on a massive fiscal consolidation drive. So at this point, I don't foresee any major hikes coming in, stemming sort of just from Eskom scenario alone.
Pete's question for you. Do you think the Fed would obtain the 2% inflation target, or did inflation targeting fundamentally change higher than the 2% target, given the rate at which Fed increased money supply during COVID with a given demand for money?
Look, I think we've sort of have enough evidence that the optimal rate for inflation in developed markets is somewhere around 2% or maybe even slightly less. So the Fed will certainly be keen to get back there. I think what changed, it happened probably in like sort of August last year, was the Fed changed their mandate, which in retrospect now looks like a little bit of a mistake. So previously the Fed's inflation target was always 2%, like as close to 2%, but below. And so as soon as inflation started like heading above 2%, it meant that they were missing their sort of objective, and they needed to start fighting inflation. And then around about July or August last year, I think it was, they changed their mandate to say that they should target inflation at an average of 2% over time. And the nuance there was that they've been operating below 2% for such a long time that they thought, there was a prospect that the pandemic would cause some inflation, and everyone hoped at that point that it would be largely transitory. And they wanted to give themselves the leeway to let that sort of transitory inflation run above 2% and come back down. And given that they were under for so long, being slightly above for a little while was going to get them the average of 2%. I think, and as a result of that, they responded too slowly. Obviously, they couldn't have forecast that we were going to have a war in Ukraine on top of the pandemic. So, a pretty tough job from their position. But do I think that they sort of fundamentally have to change the inflation targeting because, potentially increase their balance sheet too much and it's going to be painful to get back there? No, I think they'll stick to 2%. I think they would rather, and I think the current chairman's been pretty clear that he would rather cause some economic pain to get the economy rebalanced to where it needs to be operating at its most effective level than to kind of drag things out.
We are over time, but we'll do one last question for today. It's funny how some of the shortest questions might have the longest answer. So for you, Pete, why did US bonds fall so hard?
I mean, there's a very short answer to that, in that the interest rates and yield expectations climbed so high, and they climbed high off a low base. So I think, at some point during 2020 in the pandemic, when the Fed was extremely concerned about the economy freezing up, not only the Fed, the ECB and a load of other DM central banks, they were so worried about the pandemic freezing up economic activity that they kind of overjuiced the wheels to avoid that eventuality. And we saw US bond rates, 10-year bond yields touch like 80 basis points, 70, 80 basis points. Now, if you think in a sort of a normal environment when the Fed has got inflation under control and inflation's sort of averaging around 2%, and you lend them money for 10 years, you want a bit of a premium on top of that. You got to assume that US 10-year bond rates should be around 3%. And frankly, the move from like 80 bips just to sort of a normal level of 3% is the equivalent of like a 20% capital loss. And so I think the reason that bonds fell so high was that sort of perhaps this overstimulus and the US grew its balance sheet by about I think it was $5 trillion in the space of less than a year. So there was a huge amount of demand for fixed income instruments, partially intentionally to stimulate the economy. And now we got to normalize things again. And obviously you've got to remove that demand and yields have got to go back up. And the simple math of it is if you take US 10-year bonds from an 80 basis point yield to a 3% yield, that's a 20% capital loss. So that's kind of what happened.
We are well over time. I would like to thank Peter and Casey for giving of your time. And thank you very much for joining us for Essentials. We'll send out the CPDs as we get them, and we look forward to seeing you next month at Essentials. Goodbye, everybody.